Hello learners, welcome back to the course of Fundamentals of Economics and Financial Market. I am your instructor Dr. Parul Jain from Department of Economics, DAV Postgraduate College. In the last lecture, we have understood what is public finance, what are the subject matter of public finance, an important aspect of public good in the stream of public finance, the problems that was being faced when the government provides public good, and the allocation theories of marginal utility, voluntary exchange approach, and Samuelson's theory. One by one, we will be dealing with the subject matter of public finance. So, let's start today's session and discussion. Today, I'll cover one of the important topics of taxation, that is a part of public revenue, its characteristics, objectives, impact of taxation, incidence of taxation, and shifting. See, government, when we say one of the very important sources of revenue to the government is tax. It is not the only source, but a very important source, because the sources of revenue, income of the government are divided into tax and non-tax revenue. Tax involves all kinds of taxes, direct, indirect, and non-tax involves administrative fees, escheat, forfeitures, fine, penalties, these all kinds of things. So, let's discuss tax, an important source, a big source of direct and indirect. Now, tax is what? In words of P.E. Taylor, tax or taxes are compulsory payment to the government without expecting of direct return or benefit to the taxpayer. It is a compulsory contribution. Same was seconded by Professor Dalton. That is imposed by public authorities irrespective of the exact amount of service rendered by the taxpayer. To be simple, I'll put it, tax is a compulsory payment that is levied by the government on the taxpayers, whom we call assessees, without any quid pro quo, that is without any direct real benefit to the taxpayer. So, this tax must possess certain features or characteristics when we define it. First and foremost is, it is a compulsory payment that government is imposing this on the assessees, whosoever is earning from the society, from the economy, and you have to pay the taxes. Tax is a payment to the government by the people. It's not vice versa. It is the government who is imposing taxes, and it is the people, the assessee, who have to pay this tax to the government. Tax involves an element of sacrifice. A disutility is attached with tax, as was said by in the marginal utility theory by Pigou. So, whenever we are paying tax, we feel a dissatisfaction, a disutility. An element of sacrifice is always there when we are paying the taxes. However, the aim of taxes is of public welfare. The amount collected through taxes helps in reduction of inequalities, helps in providing various public goods to the people. Furthermore, as the definition says, the benefit received is not directly the return of the tax. That means it is not necessary if an individual A is paying 50,000 rupees as tax, so the benefit received in the form of public expenditure, in the form of public goods or any kind of expenditure that the government is incurring, that the benefit is also of 50,000 rupees. So, it is not direct real benefit to the taxpayer. Taxes are paid out of income. Generally, the direct taxes are paid out of your income, direct or indirect, even if we are going and purchasing something, that is out of our income. It is a legal provision that is mandatory by the government, by the law. We have to pay the taxes, and tax is not the cost of the benefit. It is not the cost. Whatever benefit, many a times it happens that the people who are not contributing in the tax because their income is exemptable or they are not earning this much to pay the taxes, the benefit received by them is same as the persons who are paying the taxes. So it is not always the cost of benefit what we are receiving. So the aim of imposing tax is first and foremost raising public revenue. Government needs to source its expenditure, government needs income. So one of the essential aims of taxation is raising the public revenue. Another important feature is regulation and control. See, if unnecessary amount, if taxes are not imposed, then the difference between have and have-nots will further widen. No regulation would be there, no control would be there in the economy. Few people would have ample amount of money to spend and few won't have any. And there would be inequalities of income and wealth along with the various goods available for people. Maybe the necessity goods are not available for the people who are not paying the tax or who belong to low income group. It also helps in capital formation in the form of assets that develop. It helps to increase in national income. Every year a tax GDP ratio is declared, what contribution taxes are giving in gross domestic product, national income of the country. So it helps in increasing. If people are paying with truth, with good moral, people are actually paying the taxes, the national income would definitely increase. And it also restricts unnecessary consumption. If taxes are imposed on such commodities which are harming your health, you won't consume that commodity. Many people, because the prices would be high, so many people will not consume. So unnecessary consumption would definitely reduce. It is very difficult for framing and employing an appropriate criteria to design an optimal system of taxation. Adam Smith stated few canons. Canons here means principles which should be kept in mind while framing a tax structure. So canons mean framing and employing of appropriate criteria in the development of tax structure. 4 important canons were given by Adam Smith, which are very famous in the field of taxation, that these canons should be known to the learners when they are dealing with taxation. First and foremost is the canon of equality. Canon of equality basically says, see, in public finance, when we define equity, because through equality we want to reach to equity. Equity means persons under similar circumstances should be taxed similarly and people under dissimilar circumstances should be taxed dissimilarly. So canon of equity basically says tax should be imposed on individuals in a way that the sacrifice or the marginal disutility or equimarginal utility felt to them is same. So that, see, 10% tax, 5,000 rupees a person is earning tax on that, and a 50,000 rupees, the amount would be different, the utility felt, the disutility felt would be same. They will have same equimarginal utilities. There should be canon of certainty. We should know when we are paying the taxes, by what method the tax is imposed on us. Everything is certain, so that the assessee or the taxpayer knows how much amount of tax he had to pay every year, what are the various tax slabs, what is the rate of taxation, how he or she has to pay the taxes, what is the process of income tax return filing. Everything is certain enough. Still also we have specific dates when we have to file advance tax, when we have to pay the income tax returns. Every year the dates are almost fixed. So canon of certainty should be there. Canon of convenience is another canon given by Adam Smith. It should be convenient for the people to pay taxes. Taxes should be simple, as well as the authorities need a proper convenient administration to these taxes, so that people understand what taxes need to pay, when need to pay it, and the authorities, it is easy to administer as well. Slowly, for convenience purposes, nowadays we see everything is digitalized when we pay our taxes. Canon of economy, that means unnecessary cost of collection of the taxes should not be high, as well as SSC should not face too much cost while they are paying off the taxes. So these four were the important canons that were given by Adam Smith. Apart from this, there are four other canons as well in the form of canon of productivity. Tax should be productive. The use of tax should yield productivity, should develop and grow economy. Tax should be elastic. Elastic in the sense, elasticity is basically what? Whenever the tax rates are changed, the tax revenue is also changed. It is the responsiveness when we talk of elasticity. So tax should be elastic. So canon of elasticity, simplicity, easy to understand, and there should be a coordination between the authorities and the people when they're designing the optimal tax structure, so that the sacrifice element felt by the tax can be reduced. Now, another important concept of tax is impact of tax. Impact here means the first place when the tax is imposed. That represents immediate money burden of the imposition of tax. That means impact of tax falls on the person from whom the tax is collected. If I am earning, I know what percentage of tax I need to pay. The first instance, first position where the tax is imposed, first point of contact of the tax, when it is with the taxpayer, it is called first position of taxes or impact of taxes. Thus, it is on the person who pays the money in the first instance. Second concept of taxation that is related to impact is incidence of tax. See, when the money burden finally settles, I can explain this. If there are two individuals, A and B, impact means the first place where the tax is imposed. Incidence means who is paying the final tax. In words of Dalton, if we see, incidence is upon those who bear the direct money burden of tax. Seligman calls the settlement of burden of tax of the ultimate taxpayer. That means when the tax rests on the ultimate payer. If impact and incidence, impact is on the same individual, it can happen. Sometimes it happens that impact is on A, but B is paying this tax. Then how this happens? This happens via a shifting process. That means the tax can be shifted as well. So it might happen that impact, that is the first place where tax is imposed, and incidence where the final resting place of the tax is there. That means the person who is paying actually the taxes can be on the same individual, and impact can be on A and incidence can be on B. That can also happen by shifting. Now, when we talk of incidence, that is the final resting of the place, Mrs. Ursula Hicks has made a distinction and told there are two types of incidences. One is the formal incidence and the other one is the effective incidence. Now, what are they? Formal incidence is the absolute amount that is imposed in the economy. That refers to the distribution of total tax burden among individuals belonging to different class in the society. Whatever rate is there, but the total tax burden that is imposed on the individual. She says that formal incidence refers to the amount of tax that is being collected by the government. Overall incidence of the tax that is imposed on the economy, on the people in the economy. However, effective incidence refers to the taxpayer reaction after paying off taxes. That means what kind of burden, what kind of sacrifice the taxpayer has felt after imposition of tax, because formal incidence is absolute terms a tax is imposed. Howsoever, when we talk of effective incidence, the amount of burden felt of tax can be different on different communities of people, on individuals. That means the variation in the distribution of consumer wants, income and allocation factors. Now, what I was talking of, sometimes it happens that impact is on A and incidence is on B. That is, B is paying the taxes, and this distance, this impact to incidence is done by shifting of taxes. Now, when we talk of shifting of taxes basically means the process of transferring the burden of tax from one person to another. This shifting can be done forward or backward shifting. Now, what does this forward and backward means? Suppose I have a commodity Q and I am a manufacturer M. I am producing this commodity Q. Now, government imposes tax. Earlier I was selling this commodity for rupees 20. Now, government imposes the tax and I increase the price of this commodity to rupees 30. When I can increase the price of the commodity by 10 rupees, that means I am shifting my tax to the consumer C. This is called forward shifting. So, when as the customs and excise, the transfer is from earlier to later stage in the process of production, from producers or importers to consumer, it is called forward shifting. However, when tax is shifted backward, it implies this way, that the seller itself would bear the burden of taxes. It is not being shifted in the forward direction to the consumer. When we are talking of shifting of taxes, there were three theories regarding shifting of taxes. One amongst them was the concentration theory. In the way back in 18th century, the school of thought of Physiocrates discovered and gave and propounded this theory of concentration. What Physiocrates told? Physiocrates told that the taxes should be imposed on surplus. And in an economy, the only sector that can produce surplus was agriculture. The commerce, the trade, the industrial, all these sectors were sterile class according to Physiocrates. So, they said that if a tax is imposed in any sector in the economy, it will slowly come and concentrate at a place where there is surplus, and surplus is generated only by agriculture. So, the tax should be imposed on agriculture. What they believe? That there is inherent tendency for all the taxes to be concentrated on the object or class which enjoys a surplus. And they believed that agriculture is the only productive sector, while other classes are not productive, or in words of Physiocrates, they were sterile classes. So, Physiocrates believed that those who could bear the taxes, they are the people who are appropriating the surplus. Thus, tax should be imposed on the land proprietors who are agriculturists who can produce surplus. So, tax should be imposed there. Reverse to this is the theory of diffusion. Diffusion theory was given by few French writers like Kennard and Mansfield. This theory is opposite of the concentration theory. The diffusion theory says that in whichever sector you are imposing the tax will slowly in the economy would diffuse and get spread in the whole economy. Like when we throw a stone in the sea, what happens? As we throw the stone in the sea, slowly the wave, that stone passes through the sea and the waves are spread all over, the disturbances all over the economy, it can be seen. So this theory stated that tax equates and diffuses themselves under the assumption of perfect competition and complete mobility of all economic agents. So according to this theory, the individual from whom tax is collected will not ultimately bear the entire burden of the tax. That means it can be shifted to other classes and finally be diffused off over the whole economy. And specifically when you study the theory given by Kennard and Mansfield, you will feel that they are favoring indirect taxes. Then comes the modern theory, that we say the demand and supply theory. This theory states that it is the relative elasticities of demand and supply that would determine whether the tax can be shifted forward or backward, and to what extent the monetary burden of tax is shifted, either forward or backward. They may be affected by the nature of market within which the seller or the buyer functions. The possibility of shifting depends on the elasticity of demand and supply. Thus, this theory asserts that tax incidence means the final resting place of the tax, the place where the person who is actually paying the tax, can be shifted only through sale or purchase transaction, being price as an engine of shifting. So, demand and supply theory basically concentrated on the elasticities of demand and supply. So, let's have different elasticities of demand and supply and see where the tax can be shifted. First situation we are taking of perfectly elastic demand. Perfectly elastic demand is horizontal to x-axis. That means a slightest change in the price would make the demand to infinity. X-axis we have taken the quantity demanded and supplied, and y-axis we have taken the price. Now suppose if in an economy the demand function is DD and SS is the supply, demand and supply intersect at point E and the output is OQ at a price P. When the tax is imposed on the seller, what would happen? If the demand is perfectly elastic, the seller cannot change the price because a slightest change in the price will make the demand infinity. So what happens? The supply function shifts from S to S1 at point E1. Thus what the seller do? The price cannot be changed by the seller. He reduces the quantity supplied from OQ to OQ1. Thus, slight increase in price will make the demand to 0. Second condition is perfectly inelastic demand. Perfectly inelastic demand, the demand curve is DD, x-axis is quantity demanded and supplied, y-axis is price. Both are intersecting at point E where price is OP. This is the price, OP. If tax is imposed on the seller, what would happen? Since demand is inelastic, the burden completely would be borne by the consumer. Why? Demand is inelastic. It may be in the case of necessity goods. Medicines can have this. You have to buy, you have to purchase that specific medicine. So the seller, what will the seller do? The seller will change the price from P to P1. The shifting can easily be done if the demand is inelastic. So the seller will only change the price supplying the same quantity. The third situation is perfectly elastic supply. Perfectly elastic supply, DD is the demand curve, x-axis is the quantity demanded and supplied, y-axis is the price. Demand is relatively inelastic or less elastic. The entire burden will fall upon the buyer. Why? Because supply is elastic. SS and DD intersect at point P. The quantity produced is OQ. So, if the supply is perfectly elastic and a tax is imposed, it can be easily shifted to the buyer and the price would rise from P to P1. Now, the fourth situation is of perfectly inelastic supply. Here you can see that the supply curve is perfectly inelastic, that is vertical to the y-axis. On x-axis we have taken quantity demanded and supply, on an y-axis we have taken the price. DD is the demand function which is elastic, which intersect supply at point E, where the price is OP. Here, if the tax is imposed and the seller shifts the price or tries to shift the price on the buyer, what would happen? Supply is inelastic. However, the buyer would reduce the demand for the commodity and the DD curve will shift to D1, D1, quantity being the same. Thus, in such a situation, the entire tax burden is not shifted on the buyer, it is not forward shifting, rather the supplier himself is responsible and bears the entire tax burden. Now, the self-evaluation question for you today is, how will the incidence of tax be determined under different elasticities of demand and supply? Hope you'll be able to answer this question by understanding the discussion today. These are few suggested readings to understand you better the subject of public finance. Next, we'll be meeting in the lecture. So, thank you for today.